After the market was showing some life this week, well, things looked a little bit different. There's been a lot of things going on in the market this week, and Riz and I are going to cover all of it right now. Good evening, my fellow Riz Elite members and all of our subscribers here on YouTube. Welcome to our weekly market recap webinar. My name is Chris. I'm part of Riz International, and I have the man himself with me this evening. Riz, how you doing tonight?
Doing good, Chris. Yourself?
Doing fantastic. It's great to be here. It's a great time to be alive, and there is a lot going on here in the market. But before we get into that, if you're watching the replay and you haven't done so already, please do me a favor and smash that like and subscribe button. We'd really appreciate it. It helps the channel grow as we continue to try and reach more and more traders to help people learn how to trade these wild markets. And it has been a red fest this week, to say the least. We have seen massive rollover in the market. We blew through all of the moving averages. We blew through the support levels, and we are now looking to make a run towards 3,800. Riz, what in the world is going on?
Yeah, we got this pullback I was anticipating. A week delayed, after last week's Bostic's comment, but we really saw the kind of impacts of Jerome Powell on Tuesday. Wednesday was not much of an effect for what he said, but we definitely saw some of this fear kind of back into the market after, he mentioned in his testimony that they're planning on perhaps doing more rate hikes, a little bit more aggressive than previously expected. So we got that, and then of course all hell broke loose on Thursday and Friday with SVB, Silicon Valley Bank, going under on Friday. So we will cover that. And that's definitely a part of why we're seeing this sort of straight waterfall down. And it's going to be a big week. In fact, it's going to be a big day tomorrow, even Sunday, as regulators and all the institutions really kind of getting together, figuring out what to do. It really reminds me of 2008, but we'll leave this for now. Again, like you said earlier, broke through all moving averages. I'm really feeling that we could see 3,800 next. And I'm not quite ready to say that we're going to hit 3,500 lows from last October, but that whole 4,200 peak that we saw, yeah, you can kiss that goodbye. I don't see us getting back there anytime soon. But that doesn't mean we can't buy some amazing, solid companies for medium to long term and try and weather the storm. And with some, more shorter term trading opportunities as they arise. But yeah, the market is very much looking bearish. I have some long positions. We did have a good week with some downside bearish bets and hedges as well. So I'm glad that that worked out. But I know I still have about 65% cash. I know quite a few elite members are also predominantly in cash, and it doesn't mean you have to be in the cash amount that I said, but having that cash reserve there is important in times like these. So interesting times ahead, especially this coming week.
It's a great point, having that capital available to take advantage when the market does roll over like this is how you make money in the market. Everybody says, buy low, sell high. Well, for you to buy low, the market has to go down. It's just part of the process. And so, we had quite a few crazy days in the market, and we will touch on SIVB later in the webinar. We have an entire presentation ready for you guys. So you're going to want to stick around for that. But we're going to kind of move along here and see what's going on. As we talked about, huge rollover this week, and we see this in all sectors. All sectors were coming down this week. Even though tech is up on the year so far, everything is coming back down, following the market down. Right now, the S&P 500 is just barely over the zero line at this point, year to date. While, energy, real estate, financials, consumer staples, healthcare, utilities, all below the zero line. So we're seeing a lot of rollover so far, with this announcement on Thursday. And there's a lot of fear in the market, I would say, right now. Riz, is there anything on this one that's really sticking out to you?
One thing, financials. financials got absolutely decimated this week. Yeah,
Yep.
everything went down, but financials were definitely one of the biggest drops. It's hard to kind of see in this, but Chris, if you could flip back to the SPX chart and then bring up XLF, take a look at this, right? This gives you a lot more context what happened uh, literally the entire week. We're selling off, selling off, selling off all the way down. So you could see that what was this drop from for this week in the ETF is about at the lows 10%. So remember, this is the ETF, not a single bank. It's the
Hmm.
ETF of all the US, or I would say all the US banks that are listed on the S&P 500. They're regional banks, some smaller, some bigger, and then obviously they're the top dogs like JP Morgan, Bank of America, uh, all that kind of stuff. So all those uh, comprise of the XLF financials sector ETF, and man, it got slaughtered. And this very much like I said, is a reaction to what's been brewing and eventually culminated on Friday with Silicon Valley Bank, which we will touch on. But yeah, I thought it'd be good to provide some context. Just looking at the ETF, you get an idea how big that is. A 10% move, roughly 8 to 10% move in a week, is a large move for ETF, especially ones that is pretty much low beta, stable like financials.
Yeah, a huge rollover in the financial sector, and we'll touch on that here in a minute. And we're going to kind of move through our recap fairly quickly because we want to pay, specific attention to what happened because this is on everybody's mind right now. Everybody's talking about it. Taking a look at oil, really not too much to talk about here. We're stuck in this channel between about 82 and 73 dollars per barrel, just really kind of bouncing around in there. Really nothing much to look at. But with that huge announcement on Friday, it looks like gold spiked up quite a bit moving in. Riz, do you think this is a reaction to what's been going on in the financial sector, people rushing back to the safe haven asset in gold, or is there something else behind this?
Yeah, absolutely. We saw about a 2% run in gold on Friday itself. Very much to do with the kind of fear in the market, as you mentioned, especially what's happening with Silicon Valley Bank and kind of a priming of what potentially could occur. There is definitely some fear of contagion, and I'll touch on that as we get into the the whole banking collapse there.
And touching on banking collapse, bonds took an absolute beating as well as far as the yields are concerned. Everything coming down. Even the dollar came down, somewhat in a similar fashion the way that gold went up. So yeah, I think like we said, there's a lot of fear right now, and this is something that we need to be very cognizant of, especially if we're looking at longer term financial investments.
Absolutely. And, to clarify as well, as you said, Chris, these are the yields. So yields went down because
Hmm.
bond prices went up. And of course, the US dollar going down a little bit. Not, I wouldn't say a little bit, but that's a sizable move lower. But not surprising. We see all these big moves occur in different financial instruments when we see these kinds of black swan events occur, and it really is a black swan event, and I'll touch on that as we get into the presentation.
Now, we told you there were some big dates coming up in the market here. Let's just pull those up real quick because we've got some big numbers being reported. Looks like here Tuesday, core inflation year on year is going to be reported. That obviously is of great concern. The inflation rate year on year is going to be of great concern to everybody in the market. That's a major catalyst. PPI month on month, retail sales month on month are coming out Wednesday. Building permits on Thursday and non-bow on Friday. Nothing really much going on here. But yeah, I mean, Riz, we've got just catalyst after catalyst happening in the market right now. Obviously, we're going to be keeping an eye on these inflation rates, and these are before market open. So this will definitely affect the market on Tuesday and Wednesday.
Absolutely, and yeah, Monday's going to be a big one.
Oh, yeah.
And like I said, this week's going to be a big one already with everything going on with Silicon Valley Bank. But it doesn't help with we got inflation numbers coming in. So it will be very interesting to see. I'm going to have a long week.
I think we all are. I think it's going to be a long week for everybody. So let's go ahead. Let's move to this because I know everybody wants to talk about it. SIVB, Silicon Valley Financial Group, getting absolutely wrecked here. And this was the talk of the town. And yeah, you'll notice that there's no print on Friday, and we'll kind of touch on that here in a second. But yeah, this bank basically going under. So let's get to our presentation. All right, here we go. This is going to be our presentation on the Silicon Valley Bank SIBV breakdown analysis. This is going to be a presentation with Riz and myself. We've got a lot to talk about. So, Riz, take it away. What in the world happened with this bank?
Whew, deep breath, deep breath. Right. So SIBV, what Silicon Valley Bank. What is it? I know there's a lot of chatter. I know a lot of elite members are aware of what's happening. There's a lot of news, a lot of stuff that's going on with financial reporting, Twitter, sourcing of different data and metrics, which is all great. But I thought I'd kind of go from top down, give an overview, give my take. And maybe some of it maybe some of it you don't. And that's fine. But I wanted to really put some clarity and give my take on it. That's the whole purpose of this. I'm not here to tell you what to do. I'm not here to predict the future or tell you written in stone what will happen, but I am here to do my best to demystify what's happening, what may occur, and where I stand on this. Okay. So with that said, Silicon Valley Bank. This is a bank that is very much so focused on providing credit, money, loans to the venture capital area. So think about small businesses, think about tech companies, startups, all these things. Silicon Valley Bank has been the go-to bank for the vast majority of all tech startups. I think this like the number is about over 50% of all tech startups eventually end up getting their funding from Silicon Valley Bank, one way or the other. So it's huge. It's very much highly exposed to everything that has to do with um, whether it's deposits from tech companies, businesses, and we'll touch on that how that can impact these large and small tech companies. In fact, and there is quite a bit of I would say damage to go around. So, Chris, if we move on to the next slide here, you'll see Silicon Valley Bank is highlighted here from Santa Clara, California, obviously, had about $209 billion in assets. This is the second largest pullback, or I would say a bank going under since, I would say, pretty much ever. Second largest. Okay. This is tremendous. The only largest one was Washington Mutual in 2008, and these are, think of it as regional banks. Okay, we're talking about regional banks. We're not talking about the large investment banks from 2008. We're talking about regional banks becoming insolvent, and this is the second largest one, about $209 billion. So if we go to the next slide, Chris, uh, it goes to show you the KBW Nasdaq Bank Index, that gray line, uh, on March 10th, which was yesterday, went down. Okay, went down, but it was holding up well. Compare and contrast that to SVB Financial Group. Okay, SIVB, the ticker we showed you, decimated about percentage wise, about 60%, and that's not including after hours. Okay, that's not including after hours. It actually dropped further, about 20% in after hours. And then compare that to First Republic Bank, FRC, if I'm not mistaken, is the ticker, and they too sold off. So we saw a sell-off in, these are just two, Signature Bank and First Republic are just two regional banks that sold off. There were many. In fact, some of them had so much volatility, they dropped so sharply that they were halted for a period of time, right? Because this mass contagion, if people are thinking, oh my God, if Silicon Valley Bank, which is one of the largest regional banks, um, is has gone under and is now insolvent, what about all these others? So everyone started either selling, whether it's institution or retail, they started selling and even maybe coming in shorting as well. So that's why we saw this massive pressure throughout all bank sector. Okay, all of the bank sector, and you can see that clear as day over here. If we move on to the next slide, you will see what happened was, and I'm gonna keep this up here for a bit as I explain. We saw Silicon Valley Bank go under this week, but we could also see, and this is sourced from Unusual Whales, but there's reporting from the SEC website. You can see the filings from Gregory Becker, who is was the CEO of Silicon Valley Bank, and you could see the filing dates of him selling shares. So overall, this is about $3.6 million, I believe, in Silicon Valley Bank stock that he sold literally as of the end of the month, last month. And that was literally not even 2 weeks ago. So this is highly suspect, but very, very disheartening and a huge, huge red flag. So when we look at this, this is brutal. This is horrible. But on to the next slide, Chris, we can assure you that one thing with Silicon Valley Bank, and I said earlier, is that when you look at a bank that is so ingrained in the tech sector, in everything to do with startups, Silicon Valley Bank was one of them. And why? Why was it one of them? They would effectively give credit to founders. They would go as far as to provide mortgages to founders, right? They would eventually become your personal wealth manager. They were effectively ingrained in the lives of the founder culture. And as a result, we saw a big pullback and massive run on the banks. What does this mean by a run on the bank? I will touch on that further. But if we go to the next slide, Chris, you will see the companies, and these are public companies besides Slack and Fitbit. They actually, I think Fitbit got bought out anyways. But point is that these are some of the companies that have their deposits at Silicon Valley Bank. Okay, there are more, but these are some of the ones that we know. Roku, for example, is one that is not on this list, but they have about 250 million or something on there held in deposits, right? In fact, we've had, and from a total tally, approximately 97% of the deposits, meaning cash deposits at Silicon Valley Bank, are not FDIC covered. So what's FDIC covered? FDIC covered is the essentially insurance for anyone who qualifies, whether if you have a bank account at a U.S. bank and you're holding cash. Again, this is for bank account, cash bank account, not for investments, not for brokerage accounts. Okay, this is just a bank account. It's covered up to $250,000 per account. So if in a situation like this where a bank goes under, the FDIC, the insurance agency, comes in and is effectively mandated with covering up to the maximum $250,000 per each individual for their account. Okay, but when we look at the books at SVB, Silicon Valley Bank, we see that 97% of all deposits are either over that threshold or they are not covered for whatever reason, either because they're in different financial products. So the vast majority of the capital at SVB is not covered. Okay, but as of yesterday, as of Friday late afternoon, early evening, the FDIC has taken over the bank. The bank is now winded down. The CEO, or the former CEO, who's been selling stock the last couple of weeks, who wink wink didn't know what happened, wink wink, right? He's gone. He's let go. But essentially, the FDIC has taken over, and they are saying, as of last statement, that they will be paying the depositors, those that have FDIC secured bank accounts with cash. They should get roughly 50% of their money back, be able to withdraw in the coming week, with the remaining 50% probably taking a few months. So think about it this way. If you had money in this bank account, in your bank account, again, this is your money, you are now locked out of it. Hence why we saw, maybe in images, maybe you've seen videos, there's a lineup outside different branches of SVB where people are trying to get their money out. They can't access their logins. They can't access their online banking. They're not seeing their balances. Poof. Right. So the problem comes where you're now seeing the average individual, I wouldn't say the average individual, but someone who's very much focused in tech, very much in California state, impacted significantly, from ranging from small companies, but also big ones like these, right? Many of them public as well. So it's tremendous fallback here. When we see something like this happen, which doesn't happen often, this very much gives me vibes of 2008. I'm not trying to fear monger here, but just trying to give you some context. This reminds me of 2008 because this is actually around the time I posted on my Instagram. This is actually around the time that Bear Stearns, okay, Bear Stearns was an investment bank that went under in 2008. Okay, March 2008. So this is actually around that time, which is absurd to me because, like, oh my god, the irony of it, right? Is coincidental, perhaps, but wow, right? It just makes you think. So I'm not saying that we're gonna have a 2008 kind of, you know, situation, but it does make you think, right? And Chris, if we go to the next slide, this will put this together and this will give you a breakdown. Okay, so let's run it through. All right, this is a very complex topic, very tricky to go in the weeds, but I've done what I can here. Number one, Silicon Valley Bank, it grows from 60 billion in assets to about 200 billion in depositor assets from 2019 to 2022. Is that coincidental? No. What they did was they very much tried to uh, go very aggressive in gaining clients, gaining depositors, gaining assets from the last 3 to 4 years. And of course, that COVID era really of massive amounts of money printing, zero rates, giving money to anyone and everyone, loose lending policies, essentially made Silicon Valley Bank the go-to place for anyone who needs capital, who needs money for their startup that isn't making any money. Okay, so they grew up massively. How did they grow that? Because they took a lot of risk. Okay, they were extending credit left, right, and center. Right. So the bank then starts to invest about 80 billion in mortgage-backed securities and bonds alike, for which they get about 1.5%. So before 2020, effectively the 2020 COVID cycle, where we saw rates get slashed to zero. During that time, what did they do? They started hedging. So they need to pay depositors back some interest, right? So what do? They started buying bonds and MBSs. Now, many people will say, well, Riz, this is just like 2008. No, it's not. And I'm not going to get in the weeds of it, but it's not like 2008. That was very different. Buying bonds and MBS is not uncommon. All these large banks do it, national or international, whether they're JP Morgan, BAC, or in this case, Silicon Valley Bank. So they all buy bonds. Now, they bought bonds generating about 1.5% coupon rate. Okay, it's a 1.5% interest on the money. So what happens when interest rates go up? When the actual rates for bonds, if you wanted to go get bonds yourself, you could generate 4.5, maybe even 5%. What happens then? Silicon Valley Bank effectively had a massive, I would say, oversight, or I would say maybe even negligence and stupidity on their part, where they didn't anticipate or factor in rates going up. And remember, when you buy bonds like these, you're effectively kind of locking yourself in. You can sell, but you're going to sell at a loss, which brings me to number three. Investors and clients start to bleed money as valuations come down. Valuations of bonds. Okay, bond prices come down, yields go up. I mentioned that earlier. So what do? Depositors start getting a little bit antsy, right? As rates continue to go up over the last year. Remember, we've had one of the fastest rate increase environments in history. Okay, when rates go up, bonds go down, right? And now, which should not be an issue if Silicon Valley Bank held them to maturity, but they're not. They got to effectively cover capital. So if you have people who the bank is using their money, remember, we know banks use depositors' money to buy assets to generate a return, right? In this case, bonds. Now, what happens when people are like, well, I'm not making, what's the point of making 1%, 1.5% of my money when I can literally buy bonds myself or put it in high interest rate savings accounts and move it over? So when enough people start doing that, what do they got to do? They got to go out and cover that money. People need to take money out. They need to cover it. So what do they need to do? They need to sell those bonds. So as a result, they had to sell the bonds for a loss. Okay. And this happened literally this week, where they announced an offering to try and raise $2.25 billion in the public markets because they took a loss. They took a loss on that bonds sale. Why did they sell those bonds? Not because they wanted to, because they had no choice. They need to cover the people that needed to take money out. There was a massive liquidity crunch that occurred. And it didn't help that a lot of these large, um, think like Peter Thiel, very big in the VC tech space, Silicon Valley, him and a whole bunch of others started taking money out. And when you have everyone trying to take money out of a bank at the same time, especially large amounts, you need to do something. And a bank is now under pressure. And that's where contagion spreads, where if everyone's taking money out, people are like, oh my God, I need to go and take the money out too. We've seen this happen in different countries and different economic climates. And that's essentially what happened. They tried to raise money because of this after losing money on the bonds because they needed to give money back to people. But because of that, they tried to raise money. And then the market's like, well, wait a sec. Are they insolvent? If they're trying to raise money, if a bank is trying to raise money, what does that tell you about the bank? Right? So that right there was the straw that broke the camel's back. Number 6, when they tried to do that offering, that was it. They essentially sealed their fate. They essentially told the public markets and everyone else that, whoa, there's something going on here. We're in trouble. Not only did we lose money on our bond offering, okay, which was about, I think, 1.8 billion. Okay, they sold $21 billion worth of bonds and they lost $1.8 billion on it. Not the end of the world for a company or a bank that has about nearly 200 billion in assets. So nothing crazy just yet. It's when they did that offering, okay, is when they kind of really the straw that broke the camel's back, as I said, it was kind of sealing their own fate because people lost confidence. When people lose confidence in the bank, people lose confidence in the system, what do? They automatically, the first reaction is to, hey, take the money out, protect our money. We don't trust this. We don't trust the system. We don't know what's going to happen. And if enough people do that, it's kind of like a recession. If everyone believes a recession is coming, it's a self-reinforcing concept where eventually you will have a recession. Okay. So moving on to number 7. The move to provide liquidity in this manner essentially scared investors, like I said, because they felt like, whoa, they don't have enough money. Why are they doing an offering to raise capital? A bank should have enough capital. In fact, they didn't. They just wanted to get more. They wanted to raise their liquidity. They had enough. I would say they had enough, but they went about it the wrong way. And here's another problem with FDIC. When we look at the books, we realize that they were not hedging the interest rates going up. So when I know as an average investor, like everyone else here, that if interest rates are going up, bonds are going to come down, yields are going to go up, what would I do? I would hedge that. If I have hundreds of billions of, assets on the line here, I would hedge that. But what did they do? They actually did not hedge. These idiots were unhedged. Imagine a bank with $200 billion in assets did not hedge their bond portfolio. They did not account for any potential change in interest rate policy, which everyone knew was coming. I've been saying it from 2021. The Fed's got to raise rates. They're going to raise them. And they did in 2022, started 22. They did, and they did fast and furiously. But these people who are, a massive regional bank, somehow their risk managers, their, all these smart people, their executives, their CEO didn't think to have this covered, didn't think that this could happen and to cover their asses and, cover in depositors, cover investors. It blows my mind. So they were not hedged. So that's the issue. They weren't hedged with rates going up and they had to sell and take a loss on the bonds. Then they tried to raise capital and then they went and did it in the wrong way. They effectively shot themselves in the foot. And then we have a massive drop in the price of the stock. Okay. Everyone starts selling the stock because, whoa, this bank is now on the verge of bankruptcy. Not quite. It wasn't. But because of everyone selling, because of everyone then having a run on the bank, it did become insolvent. So it's like a self-reinforcing prophecy. All right. So number 8, 2.7% of SVB deposits are FDIC insured. As I said, 97% aren't. Right. So what do? They take the money out, whether they have $300,000. Maybe they have $500,000 in a business operating account. Only $250K of that is covered. The other $250K is not. So what are they doing? They're trying to get their money out. And when everyone's doing it, not for $10 and $15, but hundreds of thousands of dollars, tens of thousands of dollars, you're going to have a bank run, right? So they initiated a withdrawal of about $42 billion in deposits in one day. One day. Imagine having 200 billion in assets, roughly, and not all of it is in cash. Remember, not all of it is in cash. A lot of it is in, MBSs. A lot of it is in capital markets. A lot of it is in bonds. So it's not like you have 200 billion cash. You have $200 billion in roughly value in assets. Okay, so now you have 42 billion, roughly 20 to 25% of that asset value wants to be withdrawn in cash in a single day. That was the nail in the coffin right there. So as of close of business on March 9th, the bank had a negative cash balance. So when you have a negative cash balance of roughly $1 billion, that's game over, especially when you are, I would say, a roughly smaller bank. Because when we look at JP Morgan, Bank of Canada, Bank of America, all these kinds of other larger banks, they have assets in the trillions, right? Silicon Valley Bank, big, but much, much smaller in the grand scheme of things. So when you go negative 1 billion, imagine opening up your checking account and seeing negative 1 billion. That's kind of what's happened with Silicon Valley Bank, being nearly 1,958 million negative. And that's it. You're insolvent. You are now insolvent. And when this news breaks out even more, it goes mainstream. Everyone has been talking about this, whether they're in markets, whether they're not in markets, whether they're watching the news, whether they're on Twitter, whether they're on social media. Everyone has heard about it. And that is it. People then start to capitulate. Then everyone now thinks, well, Silicon Valley Bank is one thing. What happens to the system? So this now brings me to, what do we think will happen on Monday? So there's talk that from, big, well-known, prominent investors and people in that sphere are saying that, well, the bank should not be bailed out, meaning the investors, people that hold the stock, the executives, everyone involved in the bank at the higher level should not be bailed out. If they lost their money, so be it. Creditors should also not be bailed out, meaning people that effectively lent the bank money via institutional bonds. Anything in that sense, they should not be bailed out. Who should be bailed out? Again, this is what is talk of the town, so to speak, is happening from whether they're hedge fund managers or whoever. They're saying that they should effectively the Fed should effectively come in and backstop the depositors. So the average person who put their money in the bank thinking this is safe, I'm not the one who's risking it and buying different stocks. I'm not buying different bonds. I'm just putting my money in the bank, so it's safe. It's not under the mattress or it's not in a stock drawer, right? To backstop and protect those people. And I feel like that makes sense. That makes sense. Do not do a traditional bailout where all the executives get paid out, creditors get their money. No, that's it. They took a risk, and Silicon Valley Bank was completely mismanaged. They had incompetent people in the risk management department, because it blows my mind that they did not think to hedge. They did not think to have some protection, and they did not think to at least think about what would happen 6 months down the line, a year. You're not running a lemonade stand. You're running one of the largest, regional banks. You got to be on top of this stuff, especially when it's can impact so many different individuals, from small businesses to large corporations and everything in between. So it was a massive, mistake on their part. They also were very, very much completely exposed to tech. We've seen a massive pullback in tech businesses, many smaller tech businesses, startups going under. That has a negative impact on a bank, when you have drawdowns, when you have excess risk. So I feel like they should not be bailed out in the traditional sense, but the depositors should be covered. How are they going to go about it? That's tricky, right? What if you have an account, that's not FDIC secured? Should you get money back when in any other case, someone else who has an account at another bank and their account's not FDIC secured? What kind of precedent does that state? What if ABC Bank later on goes down? Again, pretend bank. What if it goes under? Is the government going to be responsible for bailing out the average person and covering their capital there too? So it sets a bad precedent. That's the issue. I feel like there's a situation where if the government doesn't do anything, you know what's going to happen? And they're not clear with this. If they're not clear with the saying that, okay, look, we're going to come in and we're going to return people's money, we're going to sell Silicon Valley Bank's assets, maybe someone else buys it, and then we're going to start returning people's money. It's a process. It's going to take a process, but we will do it. Until they come in and say that, and I feel like even if they do, what's going to happen Monday onwards? If people are going to go to their bank, whether it's Bank of America, JP Morgan, and these companies could be completely legit. Like they have no issues with, liquidity. They don't have the risk that SVB had. They don't have a situation, anything like SVB, but all of a sudden they have a massive amount of people taking money out and they're a bank run on these banks, whether it's JP Morgan, Bank of America, whether it's whatever, whoever, right? And if that happens, that spreads contagion. That increases the risk of the financial system. It's not exactly like 2008. I will say it's not like that. That was a very different system. We had way too loose regulatory, uh, regulation was next to none when it came to that. Now banks are a lot more uh, regulated. They have a lot more capital ratios that they need to meet. They have a lot more risk management metrics that they need to meet. But Silicon Valley was one of those banks that was let off a little bit easier because it's a regional bank and not one of the big ones, right? Like JPM, uh, Bank of America. Okay, so this is something that we need to see what's going to happen. I feel like the government is going to come in. FDIC is going to come in and say, well, look, we're going to try and get you back your money, but the bank as it stands is over. Either it's going to be sold off, someone else will buy it, all the assets will be sold off on pennies to the dollar, and maybe it comes back with a different name years down the line. But Silicon Valley Bank in its current form as of Friday is done. It's over because the FDIC has taken over. That's it. The Fed and the government agencies are coming together on Monday morning for an emergency meeting for this. So we're kind of in a situation where, whoa, what's going to happen now with the rate hikes? The market was anticipating the next rate hike to be about 50 basis points. That's kind of out the water now as of Thursday and Friday. So I feel like this is a bad situation, but it's not like a 2008 situation. Am I saying go and buy every bank stock out there now and buy the dip? Hell no, absolutely not. But what I am saying is that it's not a 2008 situation. We're not going to have a financial collapse like we did back then. But this is definitely by no means good news. This is a horrible situation for pretty much everyone that has exposure to that bank, either via deposits, either via their own business, or either if they held stock or in any way, shape, or form. And even if you didn't directly hold SVB stock and you had bank stocks, well, your holdings are down, this week significantly. So everyone's kind of impacted. It's going to be interesting. It's going to be interesting to see where this goes. I'm not a doomsday caller. I'm not going to say this is going to be kind of the situation that brings down other banks. I don't think so. I think this specific bank had absolutely horrible risk management practices and they paid the price. It just kind of sucks that the average depositor is also screwed. And that's where the issue comes. I feel like everyone else should be, left hanging dry. But the people that literally all they did was just put their money in the bank, thinking that okay, it's safe. Or it's a big bank. It's not like some, you know, mom and pop, shed, and I'm putting my money in there. No, it's a regional bank. It's a large bank. It's a reputable bank that's been in, operating for decades now. So those people perhaps should be given their money back. And even if they are, I assure you, it's not going to happen right away. Imagine having, putting money in a bank account and being like, well, yeah, sorry, maybe you lost all your money. We're not sure yet. But even if we do get it back to you, it's going to be months down the line. Imagine how furious you would be, right? And how upset you would be. So it's very tragic. It sucks. But this is what happens when we have zero interest rates, massive amounts of money printing, very loose credit policy mixed in with a bank and management that really was swimming without any shorts, and the tide goes out, and here we are. This is literally that situation. If you think that the experts are that much smarter than you and I'm here to tell you that it's not quite the case. And this is one example of that. So that's my breakdown of it. Giving you a little bit more context. I know I had to throw a lot at you, but I'm sure there are some questions around SVB, around what's happening, around what could happen. So let's open it up to questions. Yeah, Chris?
No, that's great. Thank you for that amazing breakdown and explaining everything as to what is going on. Let me go ahead and end the slideshow. All right, Riz, so we had a lot of questions from our members here on Riz Lead. Of course, if you are watching this on YouTube, go ahead and post it in the comments what your questions are. Jeff from Elite says, can you cover FRC in today's webinar? I'm curious about how it may be related to the SIVB situation, which we just talked about in depth, and whether the drop is mostly due to panic fear or if there's something more substantive behind it. My feeling is more towards panic fear, but I'd love more thoughts on it. Let's take a look at FRC.
Yep.
All right, yeah, First Republic. Yeah, that looks like a lot of panic and fear with that candle, to say the least.
Yeah, and we touched on it. Massive drop. It really went from, if you look at it from Wednesday, about 120 all the way down to a little below 50. Like, wow. But it did recover. It did recover about back to 81. So yes, this is very much the kind of a panic, kind of being lumped in. First Republic Bank is a regional bank, another smaller bank, but they have come out and said that, look, what's happened with SIVB is not related to them. It's not a situation that they're in. They are not in that situation. They've come out and said that. So that reassured investors, that reassured people. But I'm sure there are people still, going to their branches for First Republic and trying to take money out. So even though that they are not at fault, they are not doing anything, their books could be fine. Everything could be running smoothly. Their risk management could be on point. But they are now effectively going to pay the price a little bit. And they need to make sure they have the liquidity. From what I know, they have the liquidity to cover withdrawals. They have everything in place, and I'm sure they've been at a long past couple of days. So I think they should be fine. I'm not confident saying that you can just go in and buy the dip. I feel like these things are best left alone, and not to be touched with a 10-foot pole even. That's me. If you feel like, you know what, I have the risk tolerance, I want to, take a position in this, then by all means. But for me, I'm okay staying away from these things. I even back in 2008, I was very, very new, very green. It was my first year. Even then, with everything going on, when I look back, I still didn't want to touch banks. I didn't want to trade them. Right?
Yeah. Absolutely, that makes sense. Now, Lucas is a fellow Canadian like yourself, Riz, and he wants to know if you foresee the effects of Silicon Valley being evident in Canada with the Canadian banking system, and says, do you see any at all long-term effects, especially with how heavily Canadian banks are regulated?
No. Canadian banks are one of the strongest, most secure banks, and that was the case in 2008, and it's even more the case now. Sure, they've also dropped. We've seen pretty much every bank in North America, I'm sure even in UK, pull back the past week because of all this stuff. But no, they're very far removed from it. And I think if you are a long-term investor, if you want to be holding bank stock, Canadian bank stocks, then yes, this could be potentially an opportunity, but that doesn't mean they can't go lower, right? What if we see an economic slowdown? We continue to see unemployment go up. We continue to see more, I would say, default rates on credit cards, auto loans, maybe even some mortgages. That could impact them. But solely in a vacuum, talking about this specific situation with SVB, no, they're not at risk from this specific situation.
All right, jumping into our people here on webinar, we again more discussion about this. How about those companies who have their funds in Silicon Valley? What do you think will be the impact to these companies? Which also goes hand in hand with the next question. Do you think companies with deposits in the bank, such as Tesla, may be negatively affected by their deposits that aren't FDIC insured?
Yeah, so this is a very interesting question, and I've been thinking about this as well. I think we have like something like Roku, which wasn't on the list, but I do know they have capital, they have deposits with SIVB, Silicon Valley Bank, and in the tune of roughly, again, this is speculation, roughly 250 million. That's a sizable cash value of Roku's total current assets. So when we think about it that way, yes, they could be significantly impacted. We cannot say for sure what's going to happen with their capital being secured. I don't think they're going to get their money back if the bank is not sold, or if they're not able to recoup a significant part of the assets. If they are, then I think they can get some of their money back. But I would not I would not wager and say, well, okay, if they had 250 million in the bank account in liquid capital, they're going to get all of that back. I don't think. I think that's best case scenario. So there are going to be some of these companies exposed. It very much depends on the company itself. I'm sure if you have something like Tesla, very large, I'm sure their position exposure to Silicon Valley Bank in terms of the cash deposits in their accounts are not too big. So not too much of an impact there. But I think when it comes to others, yes, there could be some fallback in these companies, but we will have to see by how much, right, and how the market factors this in. Right now, we do not know if even the actual, you know, regular depositor in California State who transacted with Silicon Valley Bank will have their entire uh, FDIC account back in cash. They should, they will, uh, but we don't know for those that don't have it. And I think, like I said, about 97% uh, do not meet that FDIC insured uh, requirement. So 97% of those people are now looking at their money evaporated. So we're gonna see, depending on how the regulators step in, what they say, what they implement, because this is a bit of unprecedented situation. What we saw in 2008, we saw investment banks go under. Bear Stearns, Lehman Brothers. Those were very different. Although it did impact the broader financial system, that was a very different scenario altogether than something like a regional bank that takes deposits from the average person, right? Very different scenarios. So it will be interesting to see. Unfortunately, I cannot tell you exactly what's going to happen because no one can. But I would think that those companies are going to be impacted until we get some clear direction and understanding of what the regulator is going to do. That is a big question mark.
Yeah, I mean, it's got to be a really scary situation. I mean, especially for normal people like, you and me just trying to log on to your online banking and basically there'd be nothing there. I mean, that has to be probably a nightmare scenario for a lot of people, which, like we kind of hinted at, could cause, more panic come Monday. But like we're talking about, hopefully they get involved, the government gets involved, steps in, and says, okay, we don't need to freak out, we got this covered, and we'll have to see. But I do agree with your sentiment, Riz. I don't think that the bank itself should be bailed out, nor should the executives. That
Yeah.
seems wrong.
Yeah. No, you can't have it both ways, right? You can't
Yep.
partake in the profit, and then when things go wrong, uh, you know, have pass on the downside, pass on the risk, right, to the taxpayer. You can't do that. I feel like everyone in management needs to be publicly flogged. They need to be held accountable. I think people who were, you know, taking massive amounts of risk and speculating on this stock, this company, and its assets, they need to be, not bailed out because that's a choice they made. They knew what they were getting into. There's always risk with every company, and it's not a surprise when you have a bank that about 750 $60 per share over the last year is now gone down to nearly half. There's something going on, right? Investors were already soured on this, so when it dropped from about 240, 280 to $100 a share, it's already lost a lion's share of its value the last year and a bit. So you got to be careful with these, right? It's It's a nightmare situation for investors, but this is part of the capital markets. So I don't think they should get their money back. No one's going to be recouped there, I'm sure. Uh, Again, we're solely talking about the depositors, the average person, maybe small business, because the question here is if they can't access their money, what happens? That small business, that small startup can't pay their employees. Maybe they can't pay their, contractor. They can't pay them. What happens then? That contractor, that employee who has their rent due or their car payment due or their mortgage payment due, guess what? They can't pay. So this sets off a bigger chain of events. So it really, really comes down to how far the regulators, the Fed, are able to come in and say, how far do we want to backstop this? How comfortable are we backstopping this? Because this also sets precedent. If XYZ bank goes under, are they going to do it again? We don't know that, right? So it's a very, very tricky situation. This is not all, black and white. I wish I could say, you know what? Nah, let it burn. Uh, and that's the easy answer. But it's a lot more nuanced than that. We have a lot of people whose hard-earned money, and they weren't at fault. Remember, when you put money in a bank, it just sucks that the system works this way. That when you put money in a bank, that bank gets to use its money and it gets to either light it on fire, it either gets to YOLO with it, or it gets to have proper risk management. In this case, we saw with Silicon Valley Bank, they had no idea what the hell they were doing. They didn't hedge at all. They've had you know a year to get something done. It just blows my mind. Everyone knew that rates were going up. The Fed themselves have been saying it. We're going to raise rates. We're raising rates. We're raising rates. I just don't understand that they didn't hedge at all. It's negligence. It's borderline criminal at this point. So the people that put the money in the bank account did not know all this. They were not privy to all this. They did not sign up for this. I'm sure if you told someone that, there's a 1% chance in a year that you might not be able to, access your money, I'm confident that even that 1% chance would be 1% chance too much. People will be like, hell no, I'm not going here. I'm not banking here. I'm putting my money at JPM or, Bank of America. They're not doing it. So they didn't sign up for this. And I don't think anyone signs up for this when they put their hard-earned money in a regular bank account that's supposed to be safe, that's supposed to be secure, that's supposed to be accessible. And here we are, and they're lining up and they can't even log into online banking. They can't pay their bills. They can't. It's just a nightmare situation. It's an absolute disgrace. It's a disgrace on Silicon Valley Bank management, everyone involved in it, and maybe to an extent you could maybe even blame some of the regulators for not overseeing this.
Man, it was a crazy, crazy situation, and Monday is going to be quite the day in the market. So be aware of that, everybody. Keep your eyes on the market, especially when the FDIC comes out with that decision, because it's going to be big. It's going to be a big catalyst, and then don't forget we've got more catalysts for the rest of the week, especially on Tuesday and Wednesday. So buckle up for a wild ride this week in the S&P 500. All I'm going to say. Thank you, Riz, for that amazing breakdown for Silicon Valley. I think that'll hopefully shed some light on the situation. And as they said in Jurassic Park, hold on to your butts.
Thank you, Chris. Pleasure's mine. Hopefully everyone got value out of it, gets a little bit more clarity, get my thoughts around it. I know went a bit long and yeah, maybe it gives you some insight. Maybe you felt like, whoa, okay, this is a bit more nuanced. It's not as clear what's going to happen. And I think that's the situation. There's everyone talking about it. Everyone is now all of a sudden an expert in banking regulations and bank risk management. I've seen it on Twitter. Everyone's sounding off on it. But you know what? I thought I chime in with with a real take and something that I hope gives you a little bit more insights into what may be in store next week and even onwards.
And with that note, we'll see you all in the market on Monday. Be ready because it's going to be wild.